The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Now, 2025 is set to be a pivotal year for investors, with major global trends and events set to reshape markets. From the return of Trumponomics to the rapid rise of AI and shifting Federal Reserve policies, navigating these dynamics requires keen insights and strategic planning. So how should investors navigate these themes in 2025? Well, to find out more, joining me now is Ritesh Ganeriwal, who is the head of investment advisory at Syfe. Ritesh, welcome to the show.
Hi, pleasure to be here.
Pleasure to have you on with us. Ritesh, as we close the chapter on 2025, it is evident that the past year surpassed many expectations. Was 2024 still surprisingly resilient, though? How did various asset classes perform in the past year?
So yes, 2024 actually began with almost like whispers of a recession looming large, but the resilience of the US economy actually proved otherwise. So the year was truly remarkable across asset classes. If you look at the global equity market, it delivered an impressive 18% yearly return in USD terms, while S&P 500 had a stellar year. It was 25% up. And this is on the back of a 24% return that it generated in 2023 as well. So back-to-back robust annual return, historic first achieved by strong corporate earnings as well as the continued dominance of the AI stocks. Across the world, even China made headlines, right? Like there was optimism around late-year policy support, and that spurred the Chinese, equity markets rebounding by 19% as well. And it was not just the equities that shined. Gold actually stood out. It was the best-performing conventional asset class at 27% gain. Bonds more moderate, around 3.5%. But on the other side, in unconventional, assets, Bitcoin actually stole the limelight. It skyrocketed by 122% with more favorable, regulatory changes that kind of restored investor confidence in digital assets.
I see. Well, Ritesh, then would you say investors who not only stayed invested but also diversified strategically across a range of asset classes were richly rewarded in 2024?
Absolutely. First of all, it just paid if you were invested in 2024 versus sitting on cash, right? Because cash yields had, started coming off as interest rates eased, while equity markets registered this more than 25% jump. So you would have done much, much better if you were invested than not. That's number one. Number two, within equities, returns were actually still dominated by the mega cap tech names. But we did see the rally also broadening out in the later half of the year. Also, as I mentioned earlier, except fixed income, most of the other asset classes did well. So yes, if you were able to diversify strategically across these different asset classes beyond the traditional 60-40, you would have actually done well too, and especially compared to cash.
I see. Well, then can we see a continued, resilience in 2025, or will it be a volatile one?
Look, as we step into 2025, it's clearly a new phase, and it will be marked with both opportunities as well as challenges. We've seen heightened volatility in the opening weeks, and I do expect that to continue, mainly driven by two major factors. Number one, the focal point will be the rollout of President Trump's policies, and within that, we are talking about tariffs, tax reforms, and his America First strategy, which will undoubtedly create great growth opportunities in some sectors, but also potentially creating headwinds in others, right? And number two, it's the Federal Reserve, which will remain at the center of attention because it has the dual mandate of balancing and fostering economic growth while still keeping inflation in check.
I see. Well, then, what are some key trends that are set to, shape markets for this year?
Yeah, so at Syfe, our investment team has identified 4 key themes that will shape the year ahead. Number one, the impact of Trumponomics 2.0. Number two, the Federal Reserve's actions. Number three, China's economic strategy. And of course, number four, the continued evolution of artificial intelligence. So we can then dive more into these individual pieces as we move along.
I see. So let's dive in deeper into some of these key trends for 2025 that you've mentioned there, Ritesh. Now, Trump has returned to the Oval Office. So how will the return of, Trump-era policies affect U.S. growth and inflation, and what ripple effects might we see globally?
I think straightforward, Trump has proposed, let's start with tariffs, right? He has proposed universal tariffs of 10 to 20%, as well as tariffs individually to certain countries. So Canada, 25%, and on China, as much as 60%. These will directly impact inflation by raising consumer goods prices and indirectly also affect import prices through potential dollar appreciation. So tariffs and trade policy uncertainty could overall have GDP impact as well, as much as 0.6% on the US front, and on the global front, it can be at 0.3%, assuming there is this 10% universal tariff that gets implicated or implemented.
Right.
And then I guess, you're also talking about his immigration policies, which can also be slightly negative given it will reduce labor force, so can be negative for the US, GDP growth. But on the other hand, there is tax cuts and deregulation, which could actually provide pretty strong stimulus to economic growth. And this is a potential where both the tax cuts as well as deregulation could boost US economy. So basically, you have dual effects. On one side, there is downside risks, but then on the other side, with tax cuts and deregulation, there is also upside.
Then will more tariffs be detrimental to markets? I mean, what asset classes will be the hardest hit?
Yeah, so first of all, the Federal Reserve may find it challenging to cut rates aggressively if inflation stays stubborn due to these economic policies under the new Trump administration. Market expectations actually have already shifted from 4 rate cuts to fewer than 2 this year, and which could keep the US Treasury yields elevated and the dollar strong in the near term. In terms of countries such as China, Mexico, Canada, as well as emerging markets such as Vietnam, which have significant trade surpluses with the US, they will be under pressure. But I do believe that Trump will use these tariffs as a tool to negotiate more favorable terms to the US. So how badly a country is impacted will vary depending on the outcome. And within sectors, I believe domestic sectors such as industrials are likely to benefit, while sectors such as healthcare and ESG-related themes could see slower growth due to these policy shifts.
I see. So with Trump's potential policies, presenting dual effects, offering both upside and downside risks, how might investors go about navigating this uncertainty?
So we are definitely in for a bumpier ride in 2025. So investors can look to navigate these uncertainties by adopting a more balanced and diversified approach. They can focus on sectors likely to benefit, such as domestic industrials, financials, while maintaining exposure to also defensive assets such as gold or bonds to hedge against downside risks. But at the end of the day, staying diversified and invested across regions will help to mitigate potential impacts on countries that do face these trade pressures and all. So we do believe in remaining invested for the long term rather than being too tactical, and adapting to these small changes as the economy takes shape will help investors also manage both the opportunities and the challenges in better shape.
Right. Well, Ritesh, another key theme this year is the U.S. Fed's monetary policy once again. So will the Fed maintain its easing stance, or, will economic shifts prompt a change in direction? What are markets pricing in at the moment?
So Federal Reserve, as I said earlier, will find it a little bit challenging to cut rates aggressively if inflation stays stubborn due to these economic policies. Market expectations have actually already shifted from the 4 rate cuts to fewer than 2 rate cuts, as we discussed earlier. So we are looking at Fed fund rates to be in the 3.75 to 4% range by the end of 2025.
Okay, so with the bar for the Fed to, hike rates again, quite high at the moment, what would that mean for markets, and how should investors prepare for another rate hike if that, is looming?
Right. I actually don't think investors need to worry so much about a rate hike yet.
Okay.
It's actually important to understand that the slowdown in the rate cut does not mean that the Fed is actually pivoting its policy and now moving towards hiking. If you look back in 2018, when Trump actually enacted tariffs on Chinese goods, the Fed actually refrained from reacting directly to the tariffs and viewed them as a one-time charges rather than a persistent pressure, right? So we do expect the Fed to adopt a similar stance in 2025 as well.
I see. Now, AI looks like it'll continue to be a major theme as well. So, Ritesh, will ongoing AI advancements continue to drive growth, or could new hurdles emerge in regulation and adoption?
Yeah, look, I and our team have a constructive long-term view on the AI advancements, which we believe will likely remain as a key driver for global growth because they continue to unlock both efficiency as well as innovation across industries. There are new hurdles such as strict regulations, ethical concerns, as well as slower adoption in certain sectors that could temper this growth, and there could be bumps ahead, as you mentioned. But the overall success will really depend on the individual companies to navigate through these challenges while still sort of maintaining trust, scalability, as well as compliance.
Okay, then should investors continue to go along with AI themed investments?
Yeah, so our view is that AI continues to solidify its position as a transformative megatrend. And we are still in the very early build out stage of AI evolution. And in this phase, companies are basically pouring resources into building data centers, enhancing power systems, as well as advancing the AI technologies. So the ongoing investment in these areas is poised to provide structural support to the global economic growth. And even in face of all these potential headwinds like trade wars and geopolitical uncertainties. And this gives a reason to investors to stay invested despite the potential volatility that you might see in the near term.
I see. I see. Then will big AI driven companies continue to see growth, or do you think their share prices have kind of peaked?
Great question. Actually, look, while the growth story for AI stocks remains strong, valuations do look a bit stretched. Now, going forward, earnings momentum is what will drive future price movement, especially for the mega cap tech stocks, given their already high valuation. Now, beyond that, we continue to see a super strong capex cycle emerging with the recent announcement by Trump of $500 billion of investment into AI infrastructure. Such spending boosts could provide or continue to provide the fuel that is needed to the AI stocks. And particularly, I'm excited about the picks and shovels, these providers, which will be very, very relevant in this, kind of gold rush.
I see. I see. Well, we've tackled some of the key themes that are, likely to impact markets in 2025 here. But overall, Ritesh, as we look ahead to the rest of the year, how should investors take advantage of this shifting landscape? Are there unique opportunities they can look forward to?
Absolutely. There are quite a few ways for investors to navigate the year ahead in terms of portfolio positioning. So a few ideas are number one, if you look at positioning from Trump's policies and the beneficiaries for those policies, so you could focus on sectors such as industrial, financials, as well as small caps. Number two, we have a little bit of a contrarian view on Chinese equity. We acknowledge that there are kind of like structural challenges for the economy, but we've seen the late policy support kind of kicking in. And we do think the market is overly pessimistic about Chinese companies. And on top of that, they're also trading at a significant valuation discount compared to historical averages. So there is an opportunity of a rebound coming in there if the policy support kicks in more meaningfully. Similarly, bonds is an important area where it both provides diversification and currently very attractive yields as well, and almost highest in a decade. So strong income opportunities from that standpoint. And lastly, I think diversification, right? Important to have these safe haven assets such as gold. You have alternatives that are emerging and providing much more resilience into your portfolios as well. And as well as, other alternatives such as derivatives, etc., which can help you in terms of hedging your risks could be important.
I see. Well, Ritesh, you mentioned there that investors may consider, investing into small caps, financials, and private assets. Why might that be, critical to consider for navigating the markets in 2025?
Yeah, so look, as we enter 2025, these strategic diversification becomes essential for navigating a market, which is basically presenting you both opportunities and these uncertainties. So investors definitely should look beyond just the mega cap tech stocks because there is so much concentration risk over there. and explored opportunities in these small caps because you are looking at earnings, growth picking up in these segments of the market. Also, sectors like financials are well positioned to benefit from potential policy changes. Additionally, you talked about private assets. They can provide a lot of stability and resilience to your portfolio and capture these uncorrelated and long-term growth opportunities as well. So by staying diversified and tactically kind of allocating to some of these areas, I believe investors can better navigate the challenges and capture the opportunities for 2025.
I see. Well, Ritesh, before we let you go here, we've talked about opportunities there, but what are some of the risks investors should also look out for in 2025?
Yeah, so obviously the big one is the trade war, and if it escalates, right? So especially in the US-China context, if it goes beyond just a trade war, and my hope was that Trump is using this as a bargaining tool to get better outcomes for the US. But if there is tit for tat retaliation and a scenario involving weaponizing of the financial system, that could have a much severe implication. Number two, I will say on the fiscal side of the US, if the debt levels continue to escalate, that can pose long-term economic risks as well, right? Because it will effectively raise the borrowing costs for the entire economy. And lastly, we touched upon this part, through the session. There is this high valuation and concentration risk in US equities, and they are relatively expensive by many standards. And some of these sectors, particularly technology and all, could see sharp corrections, especially if the earnings growth are, not as great as expected and the forward guidance is not as great as expected. So, yes, if you could diversify, I think this will help you navigate the 2025 and beyond much better.
I see. Well, thank you so much, Ritesh, for your time and your insights today.
Thank you so much. Pleasure to be here.
Thank you. That was Ritesh Ganeriwal, who is the head of investment advisory at Syfe. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.